The early months of 2026 have etched a permanent mark on financial history. We are witnessing a transition that many analysts warned about for decades, but few were truly prepared for. The silver market has shifted from a speculative, debasement trade into a full-blown structural systemic crisis. This is the story of the collision between high-frequency paper trading and the finite limits of physical geology. Today, we're breaking down the unprecedented volatility and delivery stress currently unfolding across the major exchanges in New York and London. The most immediate indicator of market fragility is the CME Silver Volatility Index, or CVOL. Historically, silver's volatility has been a teens to 40s affair. But in February 2026, we saw a surge past the 100-point threshold. This isn't just a high number, it represents a black swan statistical regime. At these levels, the options market is no longer pricing in standard movement. It is pricing in total uncertainty. Implied volatility for March futures recently touched 78.26%. At that level, the cost of protection, the premiums on options, becomes so high that it effectively paralyzes traditional hedging. When the CVOL breaks like this, the environment changes instantly. We see massive bid-ask spreads where liquidity dries up. Even mid-sized institutions find it impossible to enter or exit positions without moving the price by several dollars. In response, the CME Group raised margins to 18%. Think of this as a fire extinguisher, intended to force leveraged speculators out of the pool to lower the systemic temperature. The heart of the current, short squeeze, narrative lies in the March 2026 COMEX delivery cycle. The market is facing a mathematical impossibility that threatens the very credibility of the exchange. Let's look at the data from February 2026. Open interest for the March contract sits at approximately 400 million ounces. However, the registered inventory, the actual silver available for delivery, has dropped to roughly 98.1 million ounces. For decades, the futures market functioned because 98% of contracts settled in cash. But the rules have changed. Registered inventory has dropped below the psychologically critical 100 million ounce mark. This means that if just 24.5% of contract holders demand physical delivery, the system faces a technical default. If delivery fails, the exchange may be forced to invoke Force Majeure, leading to mandatory cash settlements. While this solves the logistical problem, it would likely destroy the paper-to-physical link forever. We would see a massive divergence where physical premiums in hubs like Shanghai and Dubai trade at triple-digit percentages over the New York paper price. While retail traders focus on the charts, a fundamental catalyst was set in motion back in November 2025. The US Geological Survey published its final list of critical minerals, and for the first time, silver was officially reclassified. Silver is now categorized alongside lithium and cobalt as essential to national security. This change has three massive implications. First, national security. This designation mandates a government focus on domestic supply chains. Second, strategic stockpiling. Rumors of a strategic silver reserve have already incentivized major banks to begin accumulating physical metal. Third, industrial inelasticity. We are seeing a direct competition for metal. AI hardware requires high conductivity interconnects, and the expansion of solar photovoltaics now consumes roughly 20 grams of silver per panel. Industrial demand is no longer a secondary factor. It is competing head-to-head with investment demand for a dwindling 2.1 billion ounce global inventory. The events of February 12, 2026, served as a masterclass in modern market manipulation and the weakness of automated trading. A report surfaced concerning an internal Kremlin memo suggesting Russia might re-dollarize its economy as part of peace negotiations. The reaction was instantaneous and entirely mechanical. Algorithms scanned for keywords like Russia, US dollar, and settlement, and executed massive sell orders. Within 30 minutes, silver plummeted from $85 an ounce to $74. It erased $1.4 trillion in market value in less than an hour. But here is the divergence. while the paper price crashed. The CME Vault data for that exact same day showed a withdrawal of 2.88 million ounces. This suggests a split in the market. While dumb algorithms were dumping paper contracts based on unconfirmed headlines, smart money was using the volatility as a liquidity event to take possession of physical metal at a discount. The market is currently trapped in a binary state. The equilibrium cannot hold as we approach the March delivery deadlines. We are looking at two primary endgames. In the first scenario, the historic squeeze, continued vault outflows and a delivery failure on the COMEX, combined with geopolitical escalation, could drive the price toward a calculated ceiling of $500 an ounce. This is based on a projected 10% equity rotation into hard assets. In the second scenario, the bubble collapse, a force majeure, cash settlement or aggressive liquidity tightening by the Fed could see the price retreat to major historical support levels around $54 an ounce. The divergence between the recent $120 peak and the current $70 range reflects a market that is broken and searching for a new floor. One thing is certain: the era of cheap silver has ended. It has been replaced by a high-stakes strategic competition for one of the most finite and essential industrial resources on the planet.